so now let's get it going. I'm gonna introduce Anish, if you wanna.
Thanks, Sebastian. Happy to host and welcome here and welcome those people online. It's great to have you guys here. My name's Anish Amin. I'm a transaction advisory senior manager, dealing with private equity firms on their buy side deals. And so we're going by Meredith and Jason. I'll let them introduce the experts from our tax team. But Meredith, you want to tell us a little bit about yourself?
So I'm Meredith Kowal, and I'm a partner in the Research and Development Tax Credit Group. I've been with Aprio about 7 years, and we specialize working with startups. So working with startups to make sure R&D credits are claimed, evaluating the credits to see is it even worth claiming those, because you don't want to claim it if you can't benefit from it, and doing planning around that as well. So we work a lot with Jason's team to make sure that as companies go through the growth phase, through exit or on to next things, that we're more of a business advisor more than anything. So today, we're really going to talk about different tax savings holistically, things we typically see that aren't taken advantage of, or even just questions to ask to make sure you're vetting the opportunities throughout the different phases. If you're within your first year, or if you're in your third or fifth year, or if you're on year 10, it's different depending on what phase you're in. So I'm in the R&D group, but because we do work with our clients so closely, typically I'll see enough about other credits to be able to talk about them high level. So not to be dangerous, I might have to follow up on some items, but I'm happy to share the information I do have, and Jason probably can get more technical if needed.
Yes, I'm Jason Byerly. I'm one of our tax partners here. So I focus mostly tech manufacturing clients, anywhere from startup to call it 150 million of revenue, and some even bigger than that. But we do have a lot of startup tech companies, so we are familiar with the credit side, as Meredith said, and some of that consulting that comes with helping businesses grow and see kind of the life cycle from startup to if it's an IPO or exit or what have you. So know kind of some of the ins and outs of the consulting side to help you guys grow your startups, and or any questions you might have as it relates to credits and incentives and things like that. So certainly glad to be here, and hopefully we'll get your questions answered.
Yeah, to that point, we're talking about tax savings, but if you guys have any questions while we're talking through this on anything, make this interactive as possible. If anybody has a question online, please post and we'll get it answered. Let's talk about some tax savings credits. Some unique ones that maybe people don't know about.
Yeah, we can start with R&D, because I think that's the hot topic right now. Is the section 174, the capitalization. So this was new last year. There was a new rule that came into play that requires companies, regardless of your size, your phase, to capitalize any costs that are incidental to the development. And last year, a lot of companies kind of dragged their feet. They're like, well, let's see if this goes away. If you're not taxable, it doesn't make much of a difference because it's a tiny difference. But if you are projecting to be taxable in the near future, when you're having to capitalize all those costs, it will really jack up your tax liability and the amount of tax you're going to have to come out of pocket. So one thing we've been working very diligently on over the past 6 months is working with companies to figure out, are you truly doing R&D? And if so, you might have a $5,000 credit, but you might have to capitalize, $300,000 worth of cost that would have otherwise been expensed. And so the capitalization definition of R&D is entirely different from when we do claim a credit. So the first step is really understanding that definition to see, do you qualify? But if you are within your first couple of years, you're not taxable. The R&D credit is a great way to save cash, or to have that cash benefit from the credit, because if you have less than $5 million of sales, you can claim that credit against your payroll withholding, your payroll tax. So if you claim the credit in Q1 of next year, you're not paying tax. Say you file your tax return early, you claim that credit on your tax return, and then you withhold payroll taxes from your employees' paychecks, instead of remitting those withheld taxes to the government, you get to keep those funds up to the credit amount. So it's a great cash, there's a cash benefit from claiming that credit. If you're in a loss, you don't have to worry about the capitalization. But I only bring that up because if people do have questions about this 174, it's been talked about a lot left and right, just throughout the industry. I'm happy to shed more light on that as well. But what we're finding right now is the R&D credit. It's still adding a tremendous amount of value. And if you are a startup, you only have 5 years you can take advantage of using that credit to offset payroll. So it's not on the federal side, I'm sorry. Georgia, you can do that whenever. But on the federal side, you know, you don't want to wait too long, because once your sales get too high, you can't go back and do that later on. So I know that's a lot of information.
You guys want us to ask questions as we
Yeah,
go
yeah,
along?
absolutely.
So kind of like on something related, it may not directly kind of link it to tax credit, but what about capitalization of software? Is that a good practice for startup companies that are, kind of like building a product? Should you be capitalizing that, or should you expense that? What are some of the industry best practices, so to speak?
Yeah, so the way guidance is, and Meredith referred to, is this section 174, which is obviously it's a tax code section, and so it all came about from the 2017 Tax Cut and Jobs Act. Everybody thought it was going to get repealed. It was put in there to balance the budget, and COVID hit, and Congress kind of forgot about it. Now it's a detriment to businesses. So in today's landscape, yes, from a tax perspective, you're required those intern developed costs, all that, like you're required to capitalize them from a tax perspective. From a book GAAP perspective, if you're closely following GAAP, certainly we're not GAAP experts, but I know it is something that is also required for GAAP. But so what happens if you're already capitalizing them for book purposes, we would really kind of just follow that now for tax purposes, versus before 2022, we would have said, okay, if books capitalize 2 million of software development costs under section 174, which is now has changed, but under code section 174, previously could deduct those costs. So now they're required to be capitalized. But I certainly, if the future is being audited, things like that, I certainly would suggest going about those calculations to capitalize those costs.
And that's if it's internally developed or purchased.
You talk about internally developed?
Yeah,
Yeah.
because what happens is you take, and it's in essence the salary component, right? So
5 years.
there's some.
Amortization.
Or it may be with vendors. You're not paying salaries directly, but you're getting it developed.
So
like a
contractors
contract.
or-
Exactly.
Correct.
Is that applied the same for contractors?
Yeah.
So is there a materiality threshold, like saying that, if you're just below $100,000, I mean, you don't have to worry about whatever, is there a particular threshold that you have to keep in mind?
I mean, from the tax side, the way 174 is now, I mean, it's a requirement, so there's no like minimum threshold, like what has to be capitalized. But from a book GAAP perspective, I don't know all the rules around that as far as what the landscape would be from a financial statement perspective.
As a Q of E on evaluation or something, that if we see capitalized operations, we're gonna expense it for, EBITDA purposes, but, tax. Usually there's not a materiality threshold for you guys to like an audit would have, right?
Right.
Yeah, so, yeah, for taxable purposes, based on your roles, you'd have to capitalize.
Thank you.
But if you were getting audited, and you did the books based on GAAP and then prepare the tax return, you said that you were
So in
basically
essence-
going by the
Yeah.
by
So that's
the
if
by
like
the
book
audit,
would equal tax.
Yeah, but what do
Right, so I
right?
mean, there are other costs that get factored into section 174, but putting aside if that was it. The book would equal tax for software capitalization in today's landscape. Whereas pre-2022, tax would have deducted
Or expense.
expense those costs that are capitalized for book purposes.
Right, but I guess my question was from a materiality standpoint in the audit, there is materiality. So if you did that, fell under materiality, wrote off those expenses, you would match it on the tax return.
So, no, from a tax standpoint, we would still have to look at what should be capitalized,
Okay,
unless. I mean, unless,
That's individual, whether it's.
unless everybody was comfortable that it's a very small number, right? But by letter of the law, we would have to capitalize those costs.
So do you have any advice on, as we look at this, we're gonna get screwed this year, so, and I've talked to a lot of people about this. Including our accountant. So get ready to detect an opinion. Do you have any advice on, like, okay, so when we look at this, it's about R&D. Like, do you think about, okay, well, how much of the work, the bill I get, because we offshore, so we're really up a creek. And, you know, when I get that bill for X amount every single month, like assigning, because I just get one number, that's like how. Whatever, you get it, like when you do work with offshore, sometimes you don't really get a real breakout of who did what when, right? So if I get one number, can I be thinking creatively, at least to some extent, is some of that's maintenance on existing software versus actually, you know, R&D? Any thoughts on that?
No, Meredith, you guys are probably looked into.
Yeah, so
calculation more than-
when you're looking at the offshore spend, you have to think about what's considered R&D, which the definition of R&D is, are these activities technical? And do they relate to a new or improved product or process? That's high level for this 174. Or are these costs incidental to R&D? If these costs are maintenance, so if we're keeping the lights on, or if it's more retrofit in a sense, you know what you're doing, or these contractors know what they're doing. They're basically doing something they've done before and they're just customizing it to a different data set. It doesn't have that permitted purpose, which is, are you developing a new or improved solution? If you have that support, and again, it's very subjective, it's you put together the support, then that would not be considered R&D. It would be, if you're keeping the lights on, it's maintenance, or if you look at the rights and the risk, you know, how are you paying those contractors and who has the rights? You know, if they deliver a bunch of crap, do they still get paid? There's some flexibility there as well. And what we've seen some companies do is they might take the position, they feel they have strong support that's not R&D, but their CPA might add a disclosure to kind of protect them from penalties should the IRS make a different determination.
Interesting.
But when we think about the R&D tax credit, there's a 4-part test. Anybody that, if you've done R&D credits in your prior lives, there's a 4-part test. And in addition to the technical in nature and relating to a new or improved product or process, there's 2 other parts that speak to the need to have technical uncertainty. So yes, I know I can do it, I just don't know how, and a process of experimentation. 174 it only has the first 2 parts. You don't have to have technical uncertainty for those costs to be considered R&D. So that's a moot point, is what I'm getting at when you're looking at offshore R&D. You know, the technical uncertainty doesn't matter. It's how do I, if it's truly maintenance or keeping the lights on, there's not a new iteration, there's not new features, new functionalities. That's good enough support to say it's not R&D.
And you would, as a tax advisor, you're gonna be looking to the company to help you out with what that percentage looks like generally?
And so it's a percentage from oral testimony.
Okay.
Yeah.
I mean, it's hard to say, oh yeah, this person spent 52.5% of their time right on R&D activities, right? What do you guys use? Normally a 5 to 10%.
Yeah, it's, you know,
Really?
we probably file about 800 credits a year. Same number, if not actually more, of the 174, because a lot of our 174s, these companies don't even qualify for an R&D credit. And whenever you go through an IRS exam, you know, as long as you have support, you're not just trying to avoid the law, you're not factoring in something completely different. As long as you have the support and you're documenting your train of thought, that's held out.
Some diligence, it's not like it's.
Would you, just one last question, would it make you feel better if you saw a broken out invoice like that? So,
Nobody has them broken out.
Okay,
No, I mean, it's like time tracking. I mean, we work with companies all the time that spend like tons of dollars and effort trying to get these ultra sophisticated time tracking systems to track everything. And 5 years go by, nobody uses it, right? Like it's, yeah,
You have a million codes.
Yeah.
It is. Right.
okay.
so.
15 minutes to the bathroom.
But Meredith, are there things that you typically tell startup companies, like what should you have in place early on to make sure that you're maximizing the R&D credit as opposed to just doing everything on the back end and having to go back a year and a half later sometimes if you're doing the filing an extension or what have you, like what should companies have in place to make sure that they're maximizing the credit?
I think the biggest thing is contemporaneous documentation. If you have, internal agendas or presentations or development life cycle, or even just an HR roster, if you start that early when the company's small and you have, under 10 people, and you just keep a log of who's doing what at a high level, this person support, but this person is constantly supporting development efforts or whatnot. Yeah, you just keep that on file, because the R&D isn't rocket science. It's actually it's quite simple, but also having a really good PEO makes that process a lot easier. Because if you have a good PEO, your CPA can work with them. They don't have to bug you to get data. They can pull everything they need, and then they can work on the back end and make sure the credit gets applied correctly, again, without having to bug you and ask you questions you probably don't know that you're just gonna have to be the middleman. It's like a ping pong ball. So I think starting off with a good PEO, we have recommendations we generally make, but going with someone that's a good name, they have that support, they have the innovation to make your lives easier. And then really just keeping notes in like a roster of not necessarily what everybody's working on, but are they, more admin driven, or are they, touching the product or that iteration of the product? That makes the process year over year much easier. Any other questions on the R&D board?
So if the company is really new, like you, the company's business started in January, it's like a transport company, it's a bad time for business, did nothing, just have the documents laying on the table. Can we put some expenses on that company? Collecting the gas bills, collecting the expenses we might have, trying to get the business running, but there is no income, there is no any profit coming in. Can we do that, or
To claim the credit?
to claim credit?
So if it's more to get the business up and running, that would not qualify. But if the R&D credit in of itself is effort-based. So if you have people just trying to get the product up and running, it's geared more towards the product as
Or the
opposed
service?
or the service or the solution, then that would qualify. And it's okay if there's no revenue. You don't have to have revenue to claim the credit.
Right.
And just a good rule of thumb is if you have payroll or US contractors, the credit will generally yield 6 to 8 cents on the dollar. So if you have one person that's making $100,000, just to keep it simple, and they're constantly trying to build the solution or think, how do I want to, define the requirements, that credit from that one person's effort would be about $6,000 to $8,000, just at the federal level. There's also state credits available as well, but it definitely adds up, especially if you're in early phase and people are just constantly thinking, how do I even, it's not how do I do this better, cheaper, faster, it's how do I do this?
Right. Okay, thank you.
And can I have somebody sitting in Canada doing my R&D work and find the credit?
No, so it's only US based, so that any employees or contractors have to be on US soil. They don't have to be US citizens, but the work has to be done in the US to claim the credit. If you have any work being done overseas and it's R&D, what he brought up a little bit ago, that qualifies for the capitalization, but it does not qualify for the credit. So if you have somebody in Canada doing R&D, those costs have to be capitalized. They're considered R&D for capitalization purposes, but they would not qualify. They're not considered R&D for tax credit purposes. You gotta love Congress.
And I don't know if you've mentioned this or not, but and to piggyback off of that and what you alluded to earlier is the capitalization piece, if it's R&D in the US, it's capitalized and expense over 5 years. But if it's foreign R&D costs, it's capitalized and amortized over 15 years. So I think the original idea behind this back in 17 was trying to bring jobs back to the US, right? Let's not be paying contractors in foreign countries to do this more skilled labor. Let's bring it back to the US. But at the same time, if I do have these US people, well, now I'm in a detriment that I have to add back all these costs and yes, it's a timing difference, but still it's a big hit to a lot of people's bottom line, even if it is a timing difference in that first year.
And Georgia has a really great state R&D credit. Does anybody have presence in New York? Or employees in New York? No. New York, one thing we've seen is New York also has some really.
Should we?
No. I would say no. I would say avoid New York and avoid California. I think for their states, but
Yeah,
they're very difficult.
there's some incentives in New York that we typically see overlooked, but the Georgia credit, the R&D credit, Georgia does not comply with 174. So
There are a lot of states that don't. A lot of states, speaking of California, obviously there's a lot of development that happens in California, so they're also one that decoupled from the federal. So there are a lot of states that have decoupled or don't follow the 174 like federal. So you do get a little bit of a benefit there on the state side.
Federal and state returns would be set.
Correct. Like if I had to capitalize 2 million on the federal side, I would be able to take that 2 million deduction on the state side.
I have a question when it comes into types of, so businesses, and then at the tax side, how is that business registered, being a C Corp, S Corp partnership? Are there any exceptions to the type of entity that can claim credit? And maybe in particular, like the flow through is not paying tax, and the owners, are there any exceptions to those rules when it comes into, or what types of entities can claim the credit?
Yeah, so there's no difference in how the credit's calculated, whether you're a C Corp or a pass-through entity, a partnership, or an S Corp. But there is a difference in the way the credit is passed through, right? So I mean, the C Corp obviously is going to stay in the company, whether you're claiming it for income tax purposes or, as Meredith mentioned, for payroll tax purposes. And then similarly, on the flow-through side, so what happens on the flow-through side is all the credits get passed through to the owners, right? Because it's not, as you mentioned, it's not a tax-paying entity. So those credits flow through to the individuals or an ultimate tax-paying entity, but those credits can only be used to offset income related to that particular entity. So if I have $100,000 that's passed through to me on a K1, and I have a $8,000 credit coming through to me as well, I can only use that $8,000 credit to offset the $100,000 of income. It's like if you generated a credit, in my example, if you generated a credit of $8,000, but say you had a loss of $50,000, well, now you can't claim the credit because you have a loss in your entity. So even if you're paying tax at the individual level, there was no income to offset the $8,000 credit. It's not like it just gets lumped into an income bucket that you can use the credit against.
Can it carry forward?
It can carry forward, yes. Yeah, it can
So
carry
that
forward.
entity has income.
Correct, yeah.
Thank you.
And there is some flexibility. I think C Corps might have a little bit more flexibility if you have losses built up and maybe you want to go back without having to amend. Sometimes the C Corp, because you don't also have the personal return, sometimes there can be more flexibility in regards to looking at other years and stuff like that. But the credit amount would be the same regardless.
Yeah.
Of the entity status.
Yeah, and Georgia has a nice benefit. Meredith mentioned payroll tax on the federal side, which is obviously the Social Security and Medicare, all those taxes. But so Georgia, similar with the payroll tax pieces, you claim a Georgia credit, doesn't matter the size of your company, you can be multi-billion-dollar company. And you can claim that credit against the Georgia payroll taxes. So like if the three of us are employees of a company in Georgia, claims R&D credit. And let's say what shows up on our W-2, each of us have 5,000 of W-2 withholdings to the state of Georgia. Let's say we have a $15,000 Georgia R&D tax credit. Well, that 5,000 would still show up on our Georgia W-2 as withholding, but the company actually did not remit any taxes to the state of Georgia. So that 15,000 actually stayed inside the company to allow you to expand and grow and do what you need for that money inside the company. Similarly, on the federal side, on the payroll taxes. So I think Meredith mentioned that, but I just wanted to clarify how that actually works.
So if you are expecting a tax refund, what happens there?
So you're like
For the individual.
from an individual perspective. So on the individual side, if the credit passes through to the individual, the R&D credit, at least on the Georgia side, can only offset 50% of your Georgia tax. So like if you had 6,000 of tax, but you had a $6,000 credit, you can't take your tax to zero. You still have to pay 3,000 of tax. So you can't use the R&D credit to generate a refund.
But even if you're getting a refund on a personal level, if the business isn't generating taxable income, you're not gonna add to that refund, it'll still just carry forward.
Right. Does that answer your question?
I'm still not clear. The business says, okay, this is what we're paying the employee. This is what we're holding back for taxes. The business keeps the money for that allegedly went for taxes. And so the individual and files his taxes, says, get money back, but the money is still with the company.
Yeah, no, it does not impact the individual at all.
Yeah.
Right, so like in my example, I would still claim the 5,000 as Georgia withholding. And if my tax liability was 2,000, I would still be able to claim my $3,000 refund.
Okay.
Yeah.
Thank you.
Did you have a question?
Yeah, let's say you have 3 years of losses and then the 4th year you're profitable. Can you carry over the losses for 3 years in the profit year and also claim on the tax credit if you qualify?
Yeah, you can claim the credit in lost years. There's no benefit, it'll just carry forward. So then all those credit carry forwards from those lost years now sit in this bucket when you have the income that then you can use it against.
So if you had a loss, let's say you had a loss of like $5,000, $5,000 in those 3 years. Year 4, you're profitable. You would first have the $15,000 losses to go through. So you might not be paying tax even though you're profitable. And even in that situation, the credit would still carry forward to the next year until you're actually, you've burnt through all your losses.
So there's a hierarchy. So
Yeah.
you earn the losses.
Yeah.
first
And then use the,
And how many years can you go back?
So when you claim a federal credit, if you can't use it, it'll carry forward for up to 20 years. Georgia credits can carry forward up to 10 years. This general statute of limitations is 3 years. So generally speaking, you can go back 3 years from the time you filed and amend. However, for federal, if you want to use that payroll election, so if you want to use your credit against payroll for federal purposes, that can only be done on a timely filed return. So you can't go back and amend to claim a federal credit and elect to use it against the FICA, the payroll taxes. You would amend to claim that credit, and it would ultimately be used against tax liability.
Yeah, on the same note, I have one question.
Yeah.
So if in between the carry forward years, if you change the entity type, for example, LLC to S Corp, S Corp to C Corp, are you still able to move those credits?
So in that sense, it's all at the individual level, right? So as long as the FEIN doesn't change, you should be able to still apply those credits to future years. You won't lose them.
Okay. What is FEI? Sorry.
Oh, sorry, your taxpayer identification number, like
Okay, okay,
the company's identification number.
okay, got it. And one more thing, what if, the business is making an profit and now the owner itself putting some money off from his salary, will that consider as a loan to the business?
Say that again?
So business is making a profit, owner is taking his or her salary. And then for R&D purpose, owner is putting the money back into the business from his salary. Will that consider the loan to the business, towards the business?
That won't
Right.
impact the credit, as long, I mean, I think there's some planning around,
This amount, the
well,
salary.
is it beneficial to have the salary or just not keep the money in the business? Because if you get a W-2, then there's tax implications and so it might not be worth claiming the credit on that W-2, it might be better off just taking a lower W-2.
But
If you're gonna be funding the business.
Right.
Why take that higher salary where you're gonna have all the extra taxes
Yeah.
that you already have with payroll that.
I mean, yeah, but later on you realize that business need additional money after you decided your initial salaries and in the middle of the year, probably you realize, oh, business needs some money.
Yeah.
That's tax planning,
Yeah.
your CPAs. You're having tax planning calls now,
Yeah.
right?
Yeah.
That's stuff that is.
Okay.
Yeah, so then it gets into, is this really truly a loan or is it capital contributed to the company, right? The money you're putting
Okay,
back in, so that's,
You kind of want to declare
Right,
that
so-
before the.
yeah,
or-
I mean, it's all, because then there's interest components too, right? If it's a loan and,
right,
Oh,
right,
yeah,
yeah,
so it's
that's
just-
what.
yeah, so it's, yeah, so there. And is the company really going to repay the loan?
Uh-huh,
Is that the intention to have the money be repaid? If not, then needs to be a capital contribution. So there's things to consider, right? Is it gonna, one, interest, two, is it gonna be paid back? If not, then it should be capital contribution. Into the
so
company.
if it is paid back, what is it usually the interest rate
Well, it fluctuates now, right? Our interest rates are fluctuating, so we would typically go to
uh-huh,
the IRS usually gives us stated rates on a monthly basis, so we would go look at that particular month, whatever that AFR that gives us the IRS, it's usually short-term, midterm, and long-term rates, so we would
okay,
go look at those rates for the particular time period and see what it is.
okay, got it, yeah.
And I think this is just a great example, even just the utilization of this credit applies to other credits available as well. And some other ones, we'll talk about whatever sparks the most interest, but I touched on the qualified emerging technology credit, that's mostly in New York. The employee retention credit, I know it's gotten a tremendous amount of hype over the past couple years. For any companies that did begin operations after February 15th, 2020. And had less than $1 million of sales, there are some unique exceptions for that employee retention credit. The employee retention credit, so it's a refundable credit, so you actually get a check back. Regardless of if you were in losses or profitable or whatnot. So the employee retention credit, that's been a hot topic. You've had some, Jason, that you've seen just through like the tax liability reductions, the bonus depreciation, just more tax saving.
Yeah,
tactics.
and just one other thing before we kind of jump to some of those, I just want to mention the Georgia Jobs Tax Credit.
Yeah.
So I don't know how many people here have a remote workforce versus a workforce that's actually in a physical location. But depending on certain types of or certain locations that your business is in, there's a tax credit like per employee. And also depending on where you are, you can assess whether you do a quality jobs credit or just a regular jobs credit. So the quality jobs credit is more for higher paid individuals, you get a higher credit. But so that jobs credit, no matter where certain locations allow you to use that credit against payroll withholding,
And that's a state
Mention that
credit,
one.
that's a Georgia credit.
just a Georgia credit. So you can use that credit against payroll withholding if you're in what we call an opportunity zone. And the state sets those parameters. So the state has different tiers based on the development, the economic area of certain areas. So they set those different tiers, how much credit you get, whether or not you can apply towards payroll withholding. So as you are in office locations, you're looking to move office locations, speak to your advisors to say, I'm thinking about moving locations. Is this a favorable jobs credit location? To allow you to apply it to payroll withholding, because it is a big benefit on that side.
And that's, that's to incentivize companies to keep jobs in Georgia. There's also retraining credits, so if you, you have processes in place to keep your employees getting trained, that's a little bit more, the documentation can kind of sometimes outweigh the pros of the credit, but that's another
The
state
retraining
credit.
credit is, I mean, it can be beneficial, but it's hard to claim and document. It has to be certified by a technical college, and so there's a lot of hoops and paperwork to go through on the retraining credit, but it is available and people can claim it.
You've seen a lot of that with, the physician offices and like dental practices with the retraining credit.
I don't work with clients much in that space, but they probably,
The documentation's been there in that,
Yeah.
But I can see how, just.
Or it goes like manufacturing,
Gotcha.
like when you're retraining, like how to use the machinery
Got it.
and Six Sigma and all that stuff.
and everything more on the individual side is film credits. I don't know if you guys are familiar with that, if you're looking to purchase film credits and. So you can buy a film credit for 90 cents on the dollar, whatever it is, the supply and demand kind of impacts the price there, but. So that's more on the individual side, if you're a flow through business and have income passing through to you, that's a benefit there as well. The only caveat is that spreads, like if you bought a $10,000 credit for $9,000, that $1,000 spread is actually taxable income, so there is an ROI piece at some point that you have to kind of work through when you're purchasing those film credits.
So are you saying you could buy film credits?
Yeah, so for example, like Warner Brothers or whoever here in Georgia filming, they get all these credits, they can't use them. So Georgia allows you to sell them, and there's brokers that
It's like
actually,
Bitcoin, right?
the brokers actually buy these credits and then they resell them to individuals to.
It has a
to be able to
value.
use them.
That's set
These are
determined,
tax
it's worth a
credits?
dollar.
They're
One
they're
credit's worth a
exactly-
dollar.
When would you consider buying film credits? If you.
Where were you in January?
So if you go, like, if you have $10,000 to Georgia at the end of the year, I mean, just
Right.
hypothetically speaking. If you could buy $10,000 of credits for $9,000, you'd rather pay $9,000 than the $10,000.
It's paying ordinary income tax on that $1,000.
Right.
So credits are traded at 95, like
Company-
95 cents right
I
now.
up on this, go ahead.
No, credits are trading at 95 cents right now. You could,
Yeah,
95 cents.
yeah, if you look at it from a tax benefit, you should buy them as late as you can. They can also offset, any penalties. So your tax liability goes to zero, so you don't have any underpayment penalties throughout the year. So if you waited to pay until September, bought the credits in September, you take the benefit immediately and didn't have to pay in throughout the year. That's if the credits are available in September, which they changed the code, which I'll probably know more about. You have to get it audited before the credit can be taken. And the Georgia Department of Revenue screwed that up pretty bad. So credits haven't been available because of that, but I don't know what they're looking like for 23. I don't know if y'all have a better feel on that.
I haven't looked into it closely for this year yet, but yeah, you can buy the credits up until the point in time you file the tax return. Like if you file your 2023 tax return on October 14th, 2024, and there's still 2023 credits available, you can buy them on October 14th. So it's by the time you file the return credit when you can buy those. And again, it's supply and demand. So I mean, if right now, I guess we looked up 95 cents, maybe this time next year, maybe they're 85 cents or what have you. And so you can, it's a market, there's a market for them.
There's a huge demand in Georgia. I don't see credits dropping. They used to be at 88 before
88
COVID.
About as low as I
Mhm.
saw. If you could get them below 90 cents, it was good.
Yeah.
So it's-
And film credits are the only ones you can buy and sell. All these other credits we talked about, they're not transferable. You can't buy them or sell them.
That's good.
And then there's some gaming credits too, they're like film credits that you can, you can buy and sell those. There's a lot of gaming companies in Georgia.
Do you help your clients with that? Is that something?
Yeah, the game credit, yeah, we have a whole group that they help. We can do both the jobs credits and the gaming credits.
We could transfer historic credits in Georgia too. Historic credits are transferable. There's just not a lot of,
Got it.
I think 200, 300 million or something like that a year.
That's different from, what else is giving me?
What do you mean by historic credits, you mean by historic sites?
Historic buildings, so you rehab them, you get a 30% credit in Georgia, 20% federal, and then the federal has to be taken over 5 years. So
And historic is defined as what, 1950 or something?
it's in a desert, it contributes to a national, I forget the terminology, a national designated historic site. Basically, there's historic districts. And then the site in there has to contribute to the historic district. So if the historic district was, these were all built in 1930, like, or the 30s, you would have, that building would have to contribute, like be constructed in the 30s. If you have some cinder block building built in the 90s or something like that, that's not going to contribute there, but that would, unless you get it individually listed. So you can get, somebody can get a building individually listed with the Department of the Interior. That's a whole other thing that you have to jump through. And there,
We have a few more minutes, you gotta take off, but any other questions, specific questions, or Jason, you wanna talk about bonus or salt issues that you've seen?
Yeah, so I guess I'll start with the pass-through entity tax, so if anybody's a partnership or an S corp. So if you're familiar also with the Tax Cut and Jobs Act, that from a itemized deduction perspective on an individual return, it limited the amount of deduction you can take for state taxes. It went from however much state tax you paid to now $10,000. So there's a cap that you can deduct on your personal return for state taxes, so $10,000. So if you were previously or are an owner of a pass-through entity that is profitable and pays a lot of state income taxes, and previously you could deduct all those on Schedule A as itemized deductions. That's the itemized deduction form on the 1040. So what states came back and did as a workaround to this is they said, okay, we'll in essence treat your pass-through entity like a C corp. You're not a C corp. We're going to treat you basically like a C corp and allow the entity to pay those taxes on behalf of the individuals and give the entity a deduction. So now the entity gets an expense, whereas previously the state taxes the company would pay on their owner's behalf would be treated as a distribution, not a deduction. So now, if you had $1 million of income and your state taxes, you have state taxes for all these PTE entities or PTE states, let's say adds up to $50,000. So now you're $1 million, now you're only going to pay tax on $950,000 at the individual level, as opposed to previously having to pay on $1 million. So not all states have a PTE regime, but I think we're up to 33, it's mid-30s states that have pass-through entity tax. So if you're in a multi-state jurisdiction, certainly that's something to look into. And all states are different as far as when you make the election. Some you have to make the election in a particular year, like you have to make the election now. Some you can do when you file the return. Some you actually have to pay tax with the election. So all states have different rules around when and how you make the PT election. But it certainly is beneficial to those pass-through businesses now to make those elections and pay the entity tax. Georgia does have that in place. It's going, so in previously, for 2022, only pass-through entities that had individual owners could elect the PTE, but there was enough uproar in the state that they ultimately changed that. So now any pass-through entity, if you have other pass-through entities in your structure, can elect the PTE now. So it's a nice benefit there, and it saves company's money for sure. So then the other piece I guess we're gonna touch on quick was just bonus depreciation. So I don't know how many people really have a truly fixed asset intensive business, but bonus depreciation prior to 2023 allowed you to deduct 100% of your fixed asset spend. But starting in 2023, those costs go down 20% a year. So this year, bonus depreciation is 80%. 2024 goes down to 60, and the following year 40, 20, and then ultimately to zero, I think in 2027, if my math is right. So just something to keep in mind, unless for whatever reason we have a new Congress after the 2024 elections and all this gets changed, but that's the current landscape for bonus depreciation. And bonus depreciation is new or used assets. They also changed that a few years ago. So if you purchase used assets, that also qualifies for bonus depreciation. So if you're a business and you acquire another business or you buy the assets of the business, that purchasing entity does get the benefit of the assets they purchased, and you do get to take bonus depreciation on that. Whereas previously they wouldn't have gotten that benefit.
Anything else, guys?
Any Q&A? Any more questions in person? Truly, we're looking good too. I just asked them. They said they're good. So thank you so much to the Aprio team. We really appreciate it.
Yes, okay. You know, shoot us an email.
And then I was gonna mention too, I'll send a post recap email with the recording as well, guys. And then it'll have all the highlights and all the contacts as well with the team.
We're available.
Awesome. And then feel free to take some snacks too, guys. I don't want to bring them home, please. Too much for me.
Thank you, Meredith. Thank you very much.
Nice to meet y'all.
Thank you.